We're going to have a very volatile year ahead of us.
The buy the dip half-life, as I like to call it, has been shrinking.
We will not see a repeat of what we had in the last 2 years.
The volatility market has essentially already gotten used to this new normal.
We might just be back to this low growth, sort of high inflation era that we were in, pre-pandemic.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
From Berlin, London, and New York, and for our audience worldwide, good morning. Just one time, because the birthday boy is off today. This is Bloomberg Surveillance. I'm Matt Miller, alongside Kriti Gupta in New York, Danny Berger in London. Tom Keene is off, Lisa Abramowicz off, and John Ferro has a birthday. Happy birthday, buddy. It is also New Year's Eve, the second most important thing to discuss today. Do you both have plans tonight? Are you going out? Kriti, what's New Year's Eve look like in New York?
I am staying in, but I hear Times Square is going to be popping. There's going to be confetti. There's going to be the ball drop. There's going to be performances. I will just not be a part of any of it.
I can't think of anything I'd rather do less, even when there's not COVID, of going to Times Square on New Year's. I will be nowhere near anywhere that's as crowded as that. I'm going to have a nice dinner party over someone's house. Matt, it's going to be pretty chilled out.
A little pre-tested murder mystery. Coming up on Surveillance. Wait, are we seeing celebrations already? Live in, what is this, Sydney?
It looks like they're preparing.
Auckland?
They're getting ready. They're gearing up.
Auckland fireworks, I hear. So it looks like at least they're setting off fireworks. Sounds like there are people out there as well. I see cars driving around. People are getting together.
Matt,
yeah?
One of the best financial narratives to ever come out is from Bradley Hope in Billion Dollar Whale, that Joe Lowe of 1MDB started his night of celebrating here and then rented a commercial flight for 14 of his closest friends, flew over to Vegas, and then celebrated yet again. So we're going to kind of be doing that virtually, I guess, across programming today.
Joe Lowe. In some ways, just really a champion, wasn't he? We have a lot coming up on this program for you this morning. Jay Bryson, chief economist at Wells Fargo, joins us. Michael Purvis joins us. Founder of Savanti Seth, global airline analyst. Raymond James and Christina Hooper, global market strategist at Invesco. So looking forward to a lot coming up on this program today. Let's take a look at what's going on in the markets. Mostly, for the most part, you're going to see closed markets around the world today. Right now, S&P futures down 7.5%. After a little bit of a pullback yesterday. There was one point yesterday when we were up over 4,800, actually lasted quite a while, but pulled back. So we didn't get your 71st record close. The euro there unchanged right now at 113.25. Not doing too badly considering what we've seen of late in terms of dollar strength. The 10-year yield at 150.67 right now. As I move back, I need to consider, do I continue saying one spot 5067 as Guy Johnson does, or do I switch back? Is that a British thing, Danny?
Yeah, it's definitely a British thing. I didn't hear it until I moved here. I say you take it with you. You know, you'll be like the study abroad kid coming back from Europe saying, well, in Berlin, we said spot 5.
Yeah, well, I picked it up, as I said, from Guy Johnson. So it's really, I think it's definitely a British thing, not German at all. Let's get over to Sebastian Galli right now, senior macro strategist at Nordea Investment Funds. And first off, say Happy New Year's Eve, Sebastian. Hope you have a fun and healthy night of celebration ahead of you. What do you make of 2021, and what are you looking forward to most in 2022?
First, to follow Bloomberg, of course. But the second element is what you have is a wave of liquidity. Everybody talks about it, but what is surprising about this one is normally the market is driven by 2-year ahead expectations, particularly in terms of interest rates, in terms of currency, but also in terms of equities. And when that starts to churn, everything turns with it. Basically, people start to become more prudent. They start to lighten up on credit, particularly on high yield, and things start to pop in different sections as people become either a bullion and then too careful and then corrects and comes back, the buy on dip mentality that everybody has been speaking about. But what we're seeing is that this wave of liquidity continue to push as stock pushes price, creates a feedback loop. It overshoots ever more. And what we expect is that to continue actually next year. And this is, of course, completely nonsensical because interest rates are indeed rising. Monetary policy is becoming tighter. QE is reaching its end. Even the ECB is going to start to turn more hawkish. And that means we are completely in an era of nonsense. And that to us suggests also having stuff on the side in case things go really wrong. And it typically does at some point. And that may be flexible solutions, that may be long duration positions, that could also be covered bonds. And so what you should be prepared for is that the nonsense could last longer than you expect, but also that you should be prepared for things going very badly wrong at one point.
Okay, so nonsense again in 2022, but if we're still, again, liquidity dependent, even as central banks start to tap onto the brakes, what will it take then for fundamentals to matter again in this market?
Well, the fundamentals are a function basically of our belief in the long term. If you're based in the United States, you're typically more optimistic than Europeans. You think that it's America, basically it's going to go well, things are going to pan out. You look at your kids and you think, well, maybe I can put them through college. Well, inflation starts to rise and you start to ask yourself questions because it's eroding the value of your assets. So we're seeing these savings basically decline, and they've declined considerably, which means that the market is going to be, and consumers more sensitive to inflation, especially so in the United States, less so in Europe. So some bad news in the short term, but the longer term story is one of optimism based on what you can see in the growth style, internet, the NASDAQ, Apple and the likes. It's so great. They're great companies, and they're going to continue to do well, innovate in new markets, push out mature sector companies, and just do better and better. But that storyline is based on a belief that cannot be sustained in the long run because there's so many apples in the world, and regulation is starting, even in the United States, becoming anti-Apple and the likes, and it's going to continue to ramp up because like the Chinese and the Europeans, the Americans are starting to realize that as you build these mega companies, they're also killing innovation, they're protecting themselves against competitors, and they become a bad good in the longer run. So there are only so many Apple companies, and we've seen unicorns underperform, we've seen IPOs also underperform. But that belief remains very strong in the mega cap, and it's probably going to continue to stay that way. What we say is that in a year's time, Apple company, Samsung, and the likes will start to compete more on prices because their belief in long-term growth is probably going to moderate. We're looking at decent growth in the United States, better growth actually in Europe, but not so great. At one point, this pricing, which is main relative to their competitors, which is actually not completely legal, is going to start to break down, and we're going to get competition on prices.
Yeah. Well, Sebastian, you said Apple, and my ears immediately perked up. It sounds like you're essentially saying that as you start to see perhaps growth decelerating, therefore big tech will perform pretty well, at least in the short term, at least going into 2022. But I'm curious, what happened to that recovery trade that we were so confident about going into 2021, whether it's the recovery trade here in the U.S. stock market or, say, emerging markets or commodities? Where did that go?
So much more attractive to like big cap. It's so much more attractive to like North American equities. And what you have is a competition for liquidity around the world. And where is it the most fascinating? Well, it's in the US because they're doing very well. They're innovating, they're managing well their companies. And there's this belief in the long term, which is inherent to these companies, but also in the wider populations. Europeans and Asians are more pessimistic, and particularly in Asia, because they have a much better understanding than we do about what growth is really in the
Sounds like we're getting cut off there. Sebastian, great to get some time with you, though, on this New Year's Eve. Thanks so much for joining us. Sebastian Galli there of Nordea Investment Funds, talking to us about the year that was and the year that we're looking forward to. Just got less than 12 hours here in Germany before 2022. Take a look at markets. The DAX, of course, is closed today. We closed early yesterday. In terms of Europe, we just have, I think the FTSE and the CAC 40, as well as the AEX, are still open, but they're all closing early today. In terms of the U.S., we're going to have, is a full day of trading, right? In the U.S., the S&P futures down 11 points.
Treasuries close at 2 p.m. U.S. New York time, Matt.
Yeah, and John was asking why people differentiate between the dumb money and the smart money yesterday. I was going to say the smart money is the one that takes more holiday. So the 10-year is going to be, bond trading is just a half day today, but one spot 5049. S&P, S&P kind of giving up some gains here at the end of the year. I mean, yesterday the rally petered out and it looks like we're down 11 points in futures.
I mean, do I really have to say it again, though? Light volume, light liquidity, essentially the pattern we've been hearing all week long. Matt, what really catches my eye just about this last holiday week is that investors were so sure going into it that there was going to be a Santa rally. They were taking it for granted. And yeah, there was for a second. Monday, Wednesdays, we hit record highs. But then Tuesday, Thursday, we pulled back from those record highs. Very normal after you hit essentially that milestone. And Friday, today, just seems to be another one of those kind of, all right, we're done. Let's get this new year started.
We did have last Wednesday and Thursday, I think we had 1% plus moves, right? And then Friday, which was Christmas Eve, we still had a decent rally on the S&P 500 into, as you point out, Monday and Tuesday. So 5 days in a row of gains, better than a stick in the eye. And where we are right now at 47.61. Not too far off from a record high. Right now, we're looking at what are the forecasts for 2022 year end? 5,000?
Some say 5,000, some say 4,400. Depends on how bullish or bearish you are. The real question is tech the one that's leading those charges? I mean, you're seeing this year tech once again leading the gains. Does that happen in 2022?
Yeah, there is a wide dispersion. I think I've heard as high as 5,300 as well. Coming up at 7 a.m. Eastern, Michael Purvis, founder and CEO of Talbach & Capital Advisors, joins us. He's never nervous. We're looking forward to that conversation. Don't miss it on this New Year's Eve and also John Ferro's birthday. This is Bloomberg.
With the First Word News, I'm Danny Berger. The Kremlin says Russian President Vladimir Putin is satisfied with the outcome of talks with U.S. President Joe Biden. The phone conversation set the stage for 3 sets of negotiations on European security next month. The White House says President Biden urged Putin to de-escalate tensions with Ukraine. The president warned that the U.S. and its allies will respond decisively if Russia invades. The Omicron variant is setting some grim records. For the first time, the number of daily new cases of coronavirus went over 2 million. It was the 4th day in a row of more than 1 million cases, and that was a record reached earlier in the week. More fallout from the surge in COVID cases. One of Wall Street's staunchest advocates of returning to the office is offering employees the option of working from home at the start of the year. JP Morgan says it's not changing its long-term plans, but it will allow more flexibility in the first 2 weeks of January. Meanwhile, Citigroup has asked employees to work from home for a few weeks if they are able to do so. The Port of Los Angeles will start charging a fee next month on ocean carriers that fail to pick up empty containers from the docks. The LA port is the largest in the U.S. for container traffic. It's also the main gateway for imports from China. And the buildup of cargo there led to goods shortages and price hikes before the holidays. A devastating wildfire in Colorado has destroyed hundreds of homes and forced thousands to evacuate. The disaster took place outside the city of Boulder. The fast-moving fire spread through neighborhoods in a matter of hours. One official says close to 600 homes may have burned down. So far, no reports of casualties. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Danny Berger. This is Bloomberg.
I think that Manchin is still the biggest wild card, but I think even he would be willing to take scaled back provisions, scale back child tax credit, scale back on a lot of issues. Maybe instead of $2 trillion, it goes down to $900 billion. But I do think there's a deal there. And again, I think the White House and even the progressives will take anything they can get.
That was Greg Valliere, AGF Investments Chief U.S. policy strategist on President Biden's Build Back Better plan, still on hold into the new year, and we don't know what we're going to get in terms of a number of things that are important to Americans. The child tax credit, well, important to some Americans, I should say, and not to others, which is why those plans are on hold. The SALT tax deduction cap also is an issue that still needs to be dealt with. Or maybe it doesn't, depending on how you look at it. Let's take a look at what's going on in markets on this New Year's Eve morning. We are, well, I guess it's safe to say afternoon here in Berlin, but still a morning-ish time in London, and definitely where Kriti Gupta is in New York City. S&P futures down 9, dark and early. Euro trading unchanged, 113.32. 10-year at one spot, 5.067, so just above the 150 level there. And NYMEX crude coming down 1% at 76.19. Kriti, safe to say, very thin volume today.
Very thin volume, very thin liquidity. I mean, I've been saying that on repeat all week long. But what's interesting here is that you are starting to see record highs still. You are still seeing your usual trades kick back into gear: tech, defensive names, utilities, real estate, even when the bond market is doing a whole lot of nothing.
All right, we're going to continue to keep our eye on markets regardless of how thin the volume is. But let's get to some geopolitics as well. James Lucier is managing director at Capital Alpha Partners, and he's looking at what's going on in the world with, I think it's probably safe to say, some trepidation. James, let's start with the U.S. and Russia. We had a call yesterday which President Putin came away happy with, and there's still a lot of negotiation to go on between the West and Russia in terms of what he intends to do in Ukraine. How do you view this?
Well, I think the world is actually a very dangerous place as we come to the end of 2021. The United States is totally focused in lemming-like fashion on its domestic internal politics, and yet we have a pattern whereby Russia is testing the United States and testing the NATO alliance really across the length of their entire border with the NATO alliance, from Ukraine all the way up to Sweden and the Baltics. In China, too, we have this pattern of gray zone warfare where China is simulating attacks on U.S. carriers. China is simulating attacks on U.S. forces. China has a fishing fleet that behaves a lot like a Coast Guard or a paramilitary force that is massing around Taiwan, that periodically attacks oil drilling projects in Vietnam and so forth. So it's like we're on a tripwire outside the world. I won't even go into Iran at this point. It's a very, very dangerous place, but Washington is all about the domestic politics and all about the election this year.
Well, given those geopolitical risks and given that the U.S. is concentrated internally, does the U.S. specifically, but really the Western world, have the ability to exert any sort of influence in these various issues? Again, given that, you know, Russia, China, they all see the internal conflict happening in the U.S.
Well, we see China, Russia, and Iran becoming aggressive precisely because they see internal division in the United States and precisely because they see us as being distracted and without focus. Also, there's the question of President Biden himself. Will he run for a second term? Nobody in Washington believes that he will. We all believe that this year will end, whether it's December or January, with Biden announcing that he will not run for a second term. And that's difficult because a president who is essentially a lame duck, a president who has 2 years left, is not going to be a president who can conduct a trade policy, a national security policy, or a foreign policy generally, because most countries of the world will be waiting for the next person.
If Joe Biden doesn't run again, as you suspect, who takes his place, and do you expect continuity in terms of who the Dems put up for the presidential seat?
Well, every presidential cycle is different. I think we'll have robust competition. I think that we'll see many qualified candidates here. And I think the field will include names that we saw before in the last cycle, like Tulsi Gabbard, perhaps. She's the dark horse candidate we think about, or Amy Klobuchar, or Cory Booker from New Jersey. Obviously, Pete Buttigieg and Kamala Harris are part of the mix. But all of this is frozen. We really can't begin the process of picking the new nominee until President Biden announces his intentions, which certainly can't happen until after the midterm elections. But once that does happen, we will be in full presidential succession mode. And it's also going to be very difficult for the White House to get top quality people to join the administration at the mid-tier level from the assistant secretary and above. So we're entering a period where the United States is thinking about new leaders from both the Republican and the Democratic side. And that's going to be our total focus starting not today, but 1 year from today.
That's an interesting point that you make, Jim. Let's talk about what we're going to see perhaps in just a couple of days when Congress gets back into session January 3rd. I'm talking, of course, about the Build Back Better plan. How much of this is actually priced into the markets? We saw that very public Goldman kind of downgrade in terms of growth and the impact on U.S. growth in next couple of years. But in terms of pricing it in terms of the impact, what changes in 2022?
Well, the first thing we know that we're not going to see a major corporate tax increase across the board. That's been priced into the market much of this year. And I think that anticipation that the tax increase would be less than the anticipated hike to 25% has really supported the equity markets since summer onward. Also, no capital gains tax, also no broad-based tax on individuals. So all of this is supportive. All of this has been priced into the market. That's why we have a fundamentally constructive view that something's going to happen. Also, if you look at the parts of the package that are of most concern to the investors we talk to, which are, the decarbonization elements, the clean energy parts of the plan, I've got very little doubt that $200 billion package of core clean energy tax credits is going to get done one way or the other. So the stuff that the market likes is largely baked into the cake, and I think that's supporting the markets. The markets, would like to see a stimulative boost, but the fact is that there's enough worry about inflation that we can live without more fiscal impact. You mentioned January 3rd. The really important day is going to be January 12th when we get the inflation print. And if that inflation print, the inflation estimate for the month of December, has a 7 handle, Washington is going to come screeching to a halt.
Jim, thanks so much for joining us. Real pleasure talking to you. Thanks so much for your time on this New Year's Eve day. James Lucier of Capital Alpha Partners talking about the headwinds we face in terms of geopolitical risks and domestic political issues as well. Coming up, we're going to talk to Jay Bryson. He is the chief economist over at Wells Fargo as we finish off 2021 and look forward to 2022. This is Bloomberg.
This is Bloomberg Surveillance live on Bloomberg Television and Radio. Matt Miller, Kriti Gupta, and Danny Berger in for Tom, Jonathan, and Lisa, taking the New Year's Eve day off. And not a lot to really catch up on if you are taking the day off, because we have failed to hit another record in U.S. equity markets. And we don't seem like we'll be able to do that today. It's been 70 all-time highs so far this year, but we're looking at a weaker start to the future session, down about 0.2% for S&P, NASDAQ, and Russell. A little bit more weakness from Russell 2000 futures and NASDAQ futures. Yesterday, the Russell 2000 outperformed, so maybe giving back some of that outperformance. So volumes are really light. Last I checked, European volumes are off by some 90% today. Definitely what you would expect for the last trading day of the year. Treasury market's going to be a little bit of a weird one today. It really has been all week, given that the Fed is not present in the market this week. We saw some extreme selling, some heavier than you'd expect for this holiday week volume selling earlier in the week. Now we are pretty much just hanging tight. We can't even get a move of a basis point. I should point out, though, 10-year yields still hovering above their 50-day average. Those are at 1.50. We're looking at 30-year yields similarly hovering near their 50-day average as well. We'll see how that shapes up for 2022 as we look at a Fed on course for tightening and some of the yield differentials. Now, given that we're looking at a Fed that is going on this tightening path, and Europe, for example, which is not not. We have seen some dollar strength. Euro dollar, for example, on track for its worst performance since 2015. Said another way, the dollar is on track for its best year since 2015. That is ebbing and flowing a bit today. Again, lighter volumes, a little bit of volatility. But of course, currency markets, the one market that will continue to stay open as we get a lot closing early. So at the moment, euro strengthening versus the dollar by just under 0.1%, Matt.
Danny, thanks very much. We got some breaking news. Crossing the Bloomberg terminal right now, it looks like the UK regulator has approved Pfizer's COVID pill. Paxlovid is the treatment, the name of the treatment from Pfizer, and the UK Medicines and Healthcare Products Regulatory Agency said it was found to be safe and effective at reducing the risk of hospitalization and death in people with mild to moderate COVID-19 infections who are at an increased risk of developing severe disease. So more news there out of Pfizer. Yesterday, we got a story from the New York Times that the FDA has approved the Pfizer booster shot for use in kids aged 12 to 15. Now the UK regulator is coming out with an approval of the Pfizer COVID pill. That'll be clearly a hotly debated issue. Who gets those pills first? Where can you get your hands on them? Surely they'll be sold out most places and difficult to obtain in a lot of parts of the world. So we'll continue to cover all of that COVID news for you. Not completely disconnected the economy, right? Jay Bryson, chief economist at Wells Fargo, joins us. Jay, thanks so much for coming on the program on this New Year's Day. What kind of effects are you expecting the pandemic to have on the economy as we get into 2022 now?
Well, Matt, if you look at a year ago when cases were spiking here, we had a pretty weak first quarter. And I think you could be setting up for the same sort of thing here. There has been a little bit of a pullback so far in travel. There's been a little bit of a pullback in terms of people going to restaurants. But, all that said, I wouldn't expect a complete downturn or anything coming from this. I think it's a little bit more of a speed bump in the road as people get a little bit more cautious. They don't travel as much. They don't go out to restaurants, et cetera. But again, it seems like most of us continue to go around about our daily lives. And in general, consumer spending should hold up fairly well.
How does inflation look to you as we go into 2022, Jay? Is it going to come back down, or are we going to see inflation hold or even rise?
Well, in the near term here, Matt, I wouldn't be surprised if you do see actually a 7 handle in terms of the overall rate of CPI inflation on a year-over-year basis. You talked about the pandemic here. This is only going to make the supply chain problems a little bit worse, over the next few months. And so I would expect inflation to remain relatively elevated in the first part of the year. I think it's actually going to surprise on the upside. But as you go through the year, assuming that the supply chain problems work their way out, and they eventually should, demand is decelerating right now. Both of those things should cause the overall inflation rate to actually start to recede on a year-over-year basis. But again, I think it's going to remain more elevated than what people generally believe.
Beyond supply chains, though, Jay, we've also seen staff shortages start to bite. You certainly see it in the U.S. when it comes to airlines. To what degree are you concerned about labor tightness and rising costs of labor feeding into inflation?
That's a little bit of a concern here. I mean, I think the bigger concern, though, for me, in terms of the labor market, is what happens to inflation expectations. What do people think is going to happen to inflation going forward? Because if people generally start to believe that inflation is going to remain elevated, then they start asking for bigger and bigger wage increases as you go forward. And that starts to perpetuate then the whole inflationary sort of cycle. So far, we really haven't seen that, at least in terms of the further out sort of inflation expectations. This is certainly not the 1970s yet. But if we get to that point, when people start to believe that inflation is going to remain elevated, then I think you start to have a little bit of a problem. So, in the near term, that labor market tightness could cause some sorts of issues. But assuming that the pandemic, starts to recede, those sorts of issues, those short-term issues that you talk about, I think they start to go away as well. But it's this longer-term sort of inflation dynamic that is a little bit more concerning.
Well, what would you say to those who argue that we've seen inflation show up in consumer sentiment surveys? People are worried about them, but we haven't yet gotten that wage price spiral. Therefore, it's unlikely to happen. Is that a fair argument?
I think it's not as likely as it was in the 1970s. There was an automatic adjustment that occurred back then. You had a lot more union power. Many of these people had cost of living adjustments built into their wage contracts. You don't have that today. You don't have that automatic sort of spiral that can happen. And so again, it gets back to the inflation expectations part that I talked about. If people expect inflation to remain high, they're going to ask for bigger and bigger wage increases. And then that's when you get that cost push inflation that you just talked about.
Jay, can we zoom out for a second and talk about where the U.S. fits with the world broadly? I really want to talk about kind of this growth picture. The big consensus here was coming out of the 2020 pandemic, we'd be entering this kind of global growth period, this synchronized global growth, similar to what we saw in 2016 through 2018, perhaps before the trade war with China really began. Why can we still see that, perhaps, even though we are seeing some very diverging policy stances between, say, the U.S., Europe, and even China?
Well, I think you can in general see that. I mean, if you look around the world, it's not like policy is tight anywhere. It's not like central banks around the world are clamping down right now. Maybe a few of them are starting to tap on the brakes. So I do think you can see this, global acceleration together or a global growth outlook that remains pretty reasonable. And as a matter of fact, next year, 2022, we're looking for global GDP growth around 4%. And to put that into perspective, the long-term average is around 3.5%. So we do believe next year, on a global sense, it will be a year of above-trend growth.
So how much of that then factors into, or should I say, how much of China factors in to what you just said in the idea that perhaps their zero COVID policy may be hurting some of their growth? How does that kind of trickle into the rest of the world?
Well, so, if China, so first of all, there's a cyclical thing with China, and that revolves around COVID clampdowns. And then there's a longer secular sort of thing that's going on in China, And so if you go back and you look at the pre-financial crisis sort of period, global GDP growth for those 4 years averaged over 5%. I mean, we're not going to get back to there. China's not going to grow 10% on a year-over-year basis. Right. And so that's why I think you're looking at a slower pace of growth over the next year or two than you had kind of back there. But assuming that China doesn't just completely crash and burn here in terms of their COVID sort of policies, I do believe it's very potentially you could get those very strong, 2022, that's 4% or even, a little bit higher than that.
Even if you get higher than that, Jay, is there a risk that the U.S.-China relationship deteriorates and that hurts U.S. economic growth?
I think, Matt, I think there certainly is a possibility that regardless of whether you have really strong growth or not, I think there's a possibility that the U.S.-China relationship continues to deteriorate from here. All right, how much does that hit U.S. economic growth? All right, so our exports to China are roughly $100 billion a year. Okay, it's a big number. But that you got to look at that in the context of a $23 trillion economy. So if we have a renewed trade war or whatever with China, is that going to cause a recession here in the United States? No, probably not. It's not big enough. You need a bigger shock there. Really deterioration. China invades Taiwan. Now that's a completely different story, right? But if we're just all we're talking about is continued trade tensions and things like that with China. Yes, does that hurt U.S. economic growth? Yes, but on the margin, right? Again, it's not going to cause a U.S. recession.
All right, Jay, thanks so much for joining us. Pleasure having you on the program, and Happy New Year to you and your family as well. Jay Bryson there of Wells Fargo talking to us about the economy. Take a look at markets right now in terms of S&P futures. We have red arrows on the screen, and when I'm talking about equities or equity futures, red arrows mean it's falling. Unlike when I'm talking about bond yields, where red arrows means it's rising. The euro at 113.29, the 10-year at 150.49. Danny, what's your thought on the arrows and colors that we have with bond yields?
Matt, I feel like I've been a little brainwashed by you because I hear you complain about this every day, and I too think we need to change the arrows and the colors for bond markets. I
appreciate it. Coming up, Andrew Pekos, professor and virologist at Johns Hopkins. Bloomberg School of Public Health, joins us to talk about Omicron. This is Bloomberg.
With the First Word News, I'm Danny Berger. And here in the UK, Boris Johnson's government said every adult in England has had the chance to receive a COVID vaccine booster. It's the critical part of the Prime Minister's strategy for tackling the Omicron variant. Still, the soaring caseload is putting more pressure on hospitals. Hong Kong is becoming increasingly shut off from the rest of the world because of its strict COVID policies. The city has imposed a number of flight bans, and airlines such as Cathay Pacific have been slashing inbound services. Meanwhile, Hong Kong reported its first community spread of COVID in nearly 7 months. It may be linked to an air crew member. Americans didn't let Omicron stop them from going out the week before Christmas. Activity at restaurants, stores, and other businesses increased as much as 4.8% last week compared with the beginning of the month. That's according to SafeGraph, which tracks mobile phone geolocation data. The fourth quarter is turning out to be a good one for ExxonMobil. The company says higher crude oil and natural gas prices boosted quarterly results by as much as $1.9 billion. Shares of Exxon are up 47% this year, and they're on track for their best annual performance in at least 40 years. The top airline trade group in the U.S. has filed an emergency request for a delay in the rollout of new 5G wireless services near airports. Airlines for America says 5G airwaves could interfere with aircraft equipment and disrupt flights. The wireless companies say they'll roll out the new service at temporarily reduced power in the coming months. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Danny Berger. This is Bloomberg.
Mandates have been constitutional in the United States for 116 years. Mandates work. There's good evidence that they work. It often takes the onus away from the individual and moves it more onto the society, employers, the government. That can have a big impact on people.
That was Dr. Chris Beirer, Johns Hopkins Bloomberg School of Public Health professor and epidemiologist. We're going to talk a little bit more about that in just a moment, but I want to take a look at the markets this morning. We're closed here in Germany, and the UK and France are closing early. But the U.S. is open, or it will be, and right now we see futures indicating it will open down. 9.5 points on S&P futures. Euro dollar is unchanged. 10-year yield is little changed. NYMEX crude is down 1% at 76.19. Of course, there is very low volume. Critty, if you pull up your WEI screen, you can see, I don't know if you have it clicked, but you can check the AVAT box
to look at
a comparison. Average volume at time, down 40%.
Down 40%, the S&P 500, 43% in the Dow. And then, of course, we got to talk about the NASDAQ, down about 17% from its 10-day average. So it's an understatement to say volume is light, because it's even lighter than it was all week, Matt.
Now, I won't ask you what it's like there on the street because it's 6:48 in the morning. You haven't been out since probably 3 a.m.
I can say that the light is finally coming up. The studio's a little bit lighter, starting to see a little bit, a few more people trickle into the office. So we're getting there, Matt. We're getting there.
Danny, what about London? What's it like in the city right now? If you were to walk outside and go to Greg's for a sausage roll, would you run into a lot of people?
I don't know whether that's a compliment or like a weird insult that you picture me at Greg's. I'm going to take it as a compliment. I do like myself a sausage roll, but Matt, there is nobody here. There hasn't been anybody here for the past 2 weeks. People are back working from home, but it's also the holiday period. Lots of offices are closed. So I don't want to draw too much from that, but it does make me excited that I can get my sausage roll without having to wait in a line, Matt.
Delicious.
Am I missing the secret on Greg's? What's going on with Greg's?
Yeah, you are.
It's a very good traditional sausage roll. There are Greg's people, and I've noticed in the London office, and there are Nando's people. Not sure if they're always the same.
I've only ever
in any
met
case,
Nando's people in the London office, so now I know.
Yeah. Let's get back to the reason I'm asking this question, and that is the spread of Omicron has just been like wildfire, not to draw any comparisons to what we saw happen in Boulder overnight, but just unbelievable. Another 2 million cases globally, and that's the fourth day in a row of more than 1 million cases globally. Andrew Pekos, professor and virologist at Johns Hopkins Bloomberg School of Public Health, joins us now. Doc, are we going to see, 3 million? Are we going to see in a few weeks pretty much everybody getting this virus?
Well, it's important to note that the total case counts, the official case counts, are staggering, and they're probably underestimates of how many cases of COVID-19 are going on in the country right now. It's been very difficult to really predict on a weekly basis how cases are going to go. There's some data out of South Africa showing that the surges have fallen off as fast as they increased. Hopefully that's going to happen in other places as well too, but it's really staggering the number of cases that we have. Important to note also that hospitalization rates are going up because of just the total number of cases that we're seeing.
So we've heard this as well from UK officials, that the estimates are likely, that the numbers that we're talking about are likely underestimates by a factor of 2 or 3. It wouldn't surprise you, when I say we had 2 million new cases globally in one day, it wouldn't surprise you if the real number was 5 million or even 10 million.
Absolutely not. I think all of us have heard people who are sick. The idea that the home tests are probably not being reported as effectively to public health officials as tests from a hospital or from another testing center would be. All of that is contributing to a real undercount in the number of cases that we're seeing, outside of obviously hospitalizations and deaths, because we can get pretty accurate numbers on those.
It's also, of course, New Year's Eve today. Happy New Year's Eve to you, Dr. Pekos. I'm wondering how comfortable you would be going to a bar, a big festivity, a crowded place to celebrate New Year's Eve if you are fully vaccinated with a booster as well.
Well, I think given the number of cases and the fact that so many individuals are now sort of homesick and not working and not contributing to some of the things in society, I would be very cautious about going out to any event that has a large number of people there too. Again, vaccines are protecting us against severe disease, but it's not protecting us as well against symptomatic disease. And so if you get sick, you'll be out of work for a few days and out of touch with other things for a few days. And that is what's sort of taking a larger toll on our society right now than even the deaths. The number of people that are out sick, particularly here at the hospital and in other places, is really taking a massive toll in terms of how things can function.
Doctor, talk to us about the testing piece of it all. I'm going to throw you some numbers here. Over 300 million people in the United States. Joe Biden talking about requesting 500 million rapid tests to households. If you just do some very quick math here, that's less than 2 tests per person. How often should people be testing, and how much of that should be a factor just considering the size of this country?
Well, in an ideal situation, if you're coming in contact with people on a regular basis, like going to work and those kind of things, ideally, you'd love to be able to take a rapid antigen test or something like a saliva test once or ideally twice a week. That is impossible right now because of the large number of tests that are being focused on people who are symptomatic. If you can get your hands on home antigen tests, it's nice to be able to give yourself a test before you go out to any kind of large event. Anytime you feel symptoms, it would be good to take a rapid antigen test at home, because the sooner you take yourself out of circulation, the less cases that you'll potentially lead to, because you won't put yourself in a position where you can transmit to people. But those ideal situations are just impossible to do right now because of the backlog in tests and the unavailability of testing, particularly here in the U.S.
All right. Andy Pekos, we really appreciate all the work that you've been doing off camera as well as on camera. You've been very helpful to us all year, and wish you and your family the best for a happy and safe New Year's Eve. Andrew Pekos of the Johns Hopkins Bloomberg School of Public Health, just one of the countless workers in the medical industry who are doing it just, I'm going to guess, 16 hours a day, pretty much 7 days a week, giving as much as they possibly can during this pandemic. Coming up, Michael Purvis, founder and CEO at Talbacken, joins us, Talbacken Capital Advisors, to talk about what he sees for 2022 and what he's doing with his money as we see S&P futures down 10 points. This is Bloomberg.
We're going to have a very volatile year ahead of us.
The buy the dip half-life, as I like to call it, has been shrinking.
We will not see a repeat of what we had in the last 2 years.
The volatility market has essentially already gotten used to this new normal.
We might just be back to this low growth, sort of high inflation era that we were in, pre-pandemic.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
From Berlin, New York, and London, for our audience worldwide, good morning. This is Bloomberg Surveillance, live on Bloomberg Television, live on Bloomberg Radio. You can stream us on the internet. You can probably get us in smoke signals. I'm Matt Miller, alongside Kriti Gupta and Danny Berger. Tom Keene, Jonathan Ferro, and Lisa Abramowicz are off. Two of those people don't have a birthday today. One of them does. Happy birthday, John Ferro. I hope you're sleeping still. In terms of the markets, you might as well be asleep, Kriti. We don't really see much going on. For me and Danny, it's almost over. In the U.S., of course, you haven't opened yet, and it looks like you're going to open down.
We haven't opened yet. It's just getting started. So don't, what's the word here I'm looking for? Don't put like the evil eye on it. That's what I'm translating it in my head from what my mom would tell me. Don't jinx it. That's what I'm saying. Sorry. Truly international programming here, folks. Yeah, you know what's interesting to me, though, is that the VIX is actually higher. We're looking at an 18 handle when it comes to that volatility gauge. I wonder, though, if it's going to increase as we start to see perhaps a sell-off, people getting rid of the positions that they do have in the market going into the last day of 2021.
Maybe a little bit of a year-end repositioning there. We've been talking about the light volumes all day. I've got another terminal function to throw out for you, AVAT Go. Matt, this is just really encapsulates just how little people are trading today. Currently, the composite volume on the Stock 600 is 1.6 billion. Typically, at this time of day, it is 14 times that amount. So, everyone rightfully at home celebrating John Ferro's birthday.
Yeah, exactly. And the end of 2021. Thank goodness that we're ending this year. Actually, Andy Pekos was telling us something concerning. This is the official, I guess, or the unofficial 2-year anniversary of the beginning of COVID. This is when when the world was first made aware on the internet of the first case out of Wuhan today, 2 years ago. So it feels like it's been more like 15 or 16 years, but I guess it's only been 24 months since the first case that we were aware of. Let's talk about what we got coming up on this program. I think Michael Purvis is waiting in the wings somewhere. But coming up, Savati Sith, equity research analyst at Raymond James. We also have Christina Hooper, global market strategist at Invesco, Dan Tenenbaum of Oliver Wyman, and Mercedes Carnathan of the Northwestern University Feinberg School of Medicine. So even if the markets aren't moving that much, we still have a lot to talk to you about, and we are glad if you have joined us here on Bloomberg Television and Bloomberg Radio. Oh, the markets. Didn't we just go through this? I guess we did, kind of. The S&P futures are down 13 points. Euro right now unchanged at 113.16. 10-year yield also unchanged at 150.32. The only really interesting move that I can see, because the S&P futures, that volume is so light, it doesn't really matter that much, but NYMEX crude down 1.5%. It's not a huge drop, but Kriti, I've been looking at NYMEX and Brent this month and thinking, even if you have concerns about inflation, even if you're worried about Omicron, this is an indication that Mr. Market still expects economic demand to remain strong.
Yeah, the best really kind of take on whether growth or not is happening or not, of course, really tied to that gasoline consumption in the United States, of course, the consumption in China and India as well. The big question, though, is how much of what's happening in the oil market is a function of what's happening with the kind of the European gas crisis. How much of that and the geopolitics with Russia is being factored in to the price of what you're seeing in NYMEX crude and Brent crude, for that matter.
Kriti, I'm so glad you mentioned that, because that, I think, is the one exciting market today. It is on track for its biggest drop ever in a week. It's down some 24% Dutch front month futures. I mean, it's a boring day in markets, maybe, but it still is exciting when it comes to natural gas, Matt.
It's not boring at all. It's super exciting. Thanks for joining us on Bloomberg Television and Radio. Now, Danny, actually, didn't you point out, I mean, we see the Dutch contracts down like 13%. Didn't you show U.S. nat gas up like 4%?
Yeah, it is up. It is up. Of course, the concern in Europe all has to do with supply, more LNG shippers now going to Europe. So that's helping to curb some of those record high prices we've seen. But in the U.S., it's about cold weather. It's a lot of the Midwest that's particularly cold. So that means we're on track for nat gas to have its biggest rise in a year since 2016. So, Matt, I hope you are prepared for your U.S. move with a lot of parkas and blankets.
Yeah, I'm looking forward to it. I like to be able to wear more clothing.
He's loading up his
Actually, I'm wearing khakis and a blazer today. All week, I'm not wearing a full suit. That's my own personal protest. Michael Purvis joins us, founder and CEO of Talbach & Capital Advisors. For all we know, he might not be wearing pants, but I'm pretty sure he is. Michael, how you doing? Thanks so much for joining us. Happy New Year's Eve day to you. What do you make of this? I mean, it's been an incredible year for people long equities, up like 28%, and the third year in a row of big double-digit gains. Can this continue?
I actually think it can, and I think there's sort of an instinctive natural suspicion that, hey, you can't get, 4 double-digit years in the S&P 500 in a row. That's just not supposed to happen. And I think while I appreciate that sort of instinctive concern, I actually, my price target for next year is 5,500, which is up another 15% from where we are right now there. And I think it's people have to, look, Matt, this year I was among the highest for the year end for this year at 4,250 from 12 months ago, and I upgraded that to 4,800 in July. And here we are, almost 4,800. I think we ticked through it yesterday. But look, the arithmetic of the probabilities for me spell out a pretty obvious way. The 10 years kind of range bound, that reinforces a pretty healthy equity risk premium. And you're looking at nominal GDP next year in the United States of 7 to 8%. That's just based on Bloomberg consensus forecasts there, and potentially some rest of world, international GDP that will actually recover if and when the virus continues to fade. That will reinforce the international dimension of S&P earnings. So, why would you? Why? I guess my argument is, why should 2022 be any different from 2021? Sure, it's not going to be as exciting in terms of the explosion of earnings growth with base effects, but the nominal GDP picture is very strong. You've got big tech anchoring 40% of the index with, really steady.
Wait, by the way, what is your earnings expectation, Michael? Earnings growth expectation
for next year? It's 260.
200.
I'm sorry, that's 23. 240 for next year.
240. Well, let's go
still
from
strong.
Yeah, still strong.
Yeah.
Well, let's go from the earnings or the fundamentals to the volatility picture, because we got as high as a 37 handle on the VIX this year. We're now hovering about an 18 handle. January is a seasonally volatile session, or seasonally volatile month, I should say. What are you expecting on that front?
Well, look, the VIX this entire year has been very robust. It's been if you look at high yield credit spreads, for example, they plummeted after the initial shock of COVID in the spring of 2020. And they kind of, what I argued is that they kind of led the VIX down. The VIX, you measure it on the spread of implied volatilities to realized volatility, or put call skew, or tail skew, and all those different metrics within the S&P options universe. And they've all been saying, sort of reflecting tension and some anxiety, right? And that's one of the reasons why the dips throughout this year have been 5 to 6% and not 15%, right? It's the markets have been pretty well insured coming into this. And that's a very healthy factor. One of the reasons why I've been very bullish this year and why I continue to be bullish next year, because it seems like the VIX here, it's just going to be, it refuses to just drop down to that 13, 14 level. I don't think we've had a close below 15 this entire year, despite a relentless march higher, right? There. So that is very healthy for the S&P 500. I've been, opportunistically putting on some short volatility trades, but that's, you have to sort of pick your spots there. I think people shouldn't expect.
Didn't you close?
Yeah, Michael, to that point.
I just closed. Yes, I did. But that trade was, it made money, but it wasn't a fantastic 2017 style short volatility trade, right? There. But again, that's one of the reasons why that tension within the VIX world is one of the reasons why the S&P keeps sort of relentlessly edging higher here. There.
All right, Michael, I gotta cut you off. I can hear the Cantabrian water dog in the background barking. I think your cows have gotten out. Michael Purvis coming to us there from Asturias, Spain. Actually, one of my favorite places in the entire world. Absolutely love the area there in Asturias, Spain. And I hope you have a great New Year's Eve and wish the best for you and the whole family. Thanks so much for joining us. Michael Purvis there from Talbot and Capital. Coming up at 8 a.m., Christina Hooper, Chief Global Market Strategist at Invesco, joins us to give us her take on 2022. After a bullish Michael Purvis, this is Bloomberg.
Let's get to the first word news. And the Kremlin says Russian President Vladimir Putin is satisfied with the outcome of talks with Joe Biden. The phone conversation set the stage for 3 sets of negotiations on European security next month. The White House says President Biden urged Putin to de-escalate tensions with Ukraine. The president warned that the U.S. and its allies will respond decisively if Russia invades. The Omicron variant is setting some grim records. For the first time, the number of new daily COVID cases reported went over 2 million. It was the 4th day in a row of more than 1 million cases, and that was a record reached earlier in the week. More fallout from the surge in COVID cases. One of Wall Street's staunchest advocates of returning to the office is offering employees the option of working from home at the start of the year. JP Morgan says it's not changing its long-term plans, but it will allow more flexibility during the first 2 weeks of January. Meanwhile, Citi has asked employees to work from home for a few weeks if they are able to do so. The celebrations have already begun around the globe. They're ringing in the new year. In New Zealand, they've done it with a spectacular light show at midnight in the city of Auckland. The traditional fireworks show was canceled due to the risk of coronavirus among the crowd who were expected to attend. Some really beautiful pictures there of that fireworks. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. We'll continue to have your New Year's updates as more cities enter 2022. I'm Danny Berger. This is Bloomberg.
transitory for longer doesn't make any analytical sense because behaviors change. And we're seeing that. We're seeing price setting behavior change. We're seeing wage bargaining behavior change. We're seeing consumption behavior change. So what's different this time around, John, is that inflation is changing behaviors. And the Fed has to be very sensitive to that.
That was Mohamed El-Erian, Bloomberg opinion columnist and Queens College, Cambridge president, speaking yesterday to Jonathan Ferro, whose birthday is today. Happy birthday, John Ferro. Miss you, buddy. Can't wait to get back home. I am flying home a week from today, moving back to New York from cold and gray Berlin, although obviously the temperature difference isn't that big. The market difference is big. We're closed today in Germany. The Germans have decided, because it's New Year's Eve, why send people to work today? Take the day off. Tomorrow, New Year's Day, is on a Saturday, so they give you the day off on a Friday. Not the case in the U.S. I spent a lot of time on the floor of the New York Stock Exchange, and they are pretty severe when it comes to their approach to trading days off. They do not like to cut days out of the schedule. Right now, we're looking at the S&P 500 actually down. It would have been better for those long equities maybe if they had said, don't worry about it. January 31st, you can have off, but they just can't. It's in the rule book. John actually found it and read the rule yesterday. You can't have the last day of the year off. Exactly. So S&P 4761, S&P futures down 11, euro dollar unchanged, 10-year yield really unchanged, NYMEX crude down 1.5%. But Kriti Gupta, who you just heard, sorry, didn't mean to whom you there, in New York City, has pointed out all morning it is very low volume. Kriti, what are you seeing?
Yeah, I'm making all these comments from the sidelines, the peanut gallery, basically. The big thing you have to keep in mind here is that we are ending 2021 on a very different note than when we started it. This was supposed to be the year that we were going to see this massive recovery trade. Energy was going to boom. We're going to hear a lot of these riskier trades boom. It wasn't going to be a tech-driven year. And then at the end of the year, Matt, guess what happened? It became a tech-driven year, especially in the last 6 months.
Yeah, it's been fascinating to watch. The gains have been monstrous, especially if you were just an index investor. You've done really well. 2022 might be different. Danny Berger's with us out of London. Danny, I've heard a lot of people say 2022 is a stock picker's year. You hear that
don't
too?
Say it. I'm so tired of that phrase, Matt, because every year we say this. We always say, okay, there's going to be more volatility. There's going to be more divergences between equities, but it kind of never happens. It's always staying and holding indexes perform better. But I should note this month, equal weighted ETFs have outperformed the broad, market cap type ETF. So maybe there is some hope that recoveries, stock gains will be more broad-based and not, as you said, Kriti, just concentrated on those technology names.
Yeah, and this really brings to the question of airlines, for example. That was the volatility trade, essentially, of the first couple months of the year. And now, look at what they're doing. They're kind of declining a little bit. You're not seeing that continued momentum that you saw at the start of the year.
All right, well, since you mentioned that, let's bring in Savanti Syth. She is an equity research analyst at Raymond James. She's focusing in on what's going on with the airlines for us. Savi, thanks so much for your time out of Knoxville, Tennessee. It must be awesome. I can't wait until I live closer and can drive down to places like that. What are we to expect in terms of the airlines? I mean, we've seen thousands and thousands of cancellations. I'm scheduled to fly out of BER, possibly the worst new airport in the world, into New York City in a week from today. What's the chances that I make that flight?
I think it's good, Matt, and I wish you good luck. Look, it's gained a lot of attention, and clearly the airlines are having a lot more trouble this year because of Omicron. You have a high level of vaccination among airline employees, and yet because of Omicron, I think the absenteeism is higher than you would have expected otherwise, which is catching them by surprise at a time where you also are having some winter weather issues across the U.S. And so the actual cancellations are around 5 to 6% across for U.S. airlines. And especially as you get into next week, we do have a month resetting. As you know, airline crews have a certain amount of time that they can fly during a month, and that gets to a critical point towards the end of the month. So as you fly here earlier in the month next month, I think some of those kind of tight staffing issues will have alleviated. Not to mention, peak periods are kind of starting to wane down as you get past kind of the first week of January.
Still, it does seem like the issues for airlines stack up. Already you have people waiting last minute to book because they're concerned about restrictions. Now you add on to that cancellations because of staff shortages. Just how difficult operationally has this period been and will be for airlines?
Yeah, it's a good question, Danny. I mean, this has been a downturn like no other for airlines, and there's not been any good rule book as to how to perform in this. Airlines learn a lot from history, and they really fine-tune their operations. Last year there was no kind of demand. This year suddenly it's gone from 0 to 60, mostly on leisure and visiting friends and relatives. And just with COVID, it just adds this kind of extra level of uncertainty with the employees. And there is a risk that, what does this do to demand as people see that and not wanting to deal with it? But there still seems to be a kind of a strong desire to travel, to meet. And so I think it's going to be choppy. And I think some of the CDC rule changes will also help now that the quarantine periods are a little bit lower. It definitely has been challenging from a demand standpoint, from an operation standpoint. But we see as you go through 2022 and we have a better handle on COVID and we have more therapeutics on the market, I think things will start to improve for operations and demand.
Well, it's interesting that you mentioned we have about a minute here left. Talk to us a little bit about simply the bottom line. A lot of these airlines are still doing things like cargo loads, for example, still lobbying for federal aid. How much of the kind of travel resurgence, the passenger resurgence, hasn't actually helped perhaps how much these airlines are actually raking in?
Yeah, I mean, crazy, like the at least for the U.S. airlines, the government support has ended, and they're in a better footing. They're getting close to, some airlines are profitable, some airlines are getting close to profitability. I think the big thing for airlines will be the recovery in business demand. I think leisure VFR is strong. That's given them at least an opportunity to build their cash levels versus much of last year they were burning cash, if not for the government support. And so I think you had earlier about JP Morgan pushing back return to office. I think we need to have return to office and a return to business travel for these airlines to get into kind of a stronger footing from a profitability standpoint. And hopefully we'll start to see that as you get to kind of end of 1Q and into second quarter of next year.
Savi, thanks so much for joining us. Savanti Syth there talking from Raymond James about airlines. Coming up, Dana D'Auria, Co-Chief Investment Officer at Envestnet, joins us on this New Year's Eve day as we see S&P futures down 10. This is Bloomberg.
This is Bloomberg Surveillance live on Bloomberg Television and radio. Matt Miller, Kriti Gupta, and Danny Berger, that's me, and for Tom, Jonathan, and Lisa on this New Year's Eve. I hear it's someone's birthday. I'm not sure about that, though. We might have said that a few times on this program.
Happy birthday,
and
John.
Matt, happy birthday, John. Matt, earlier we were talking and I was saying, okay, I just want markets to be calm because I'd rather be picking out what bottle of bubbly I'll be drinking later. But I have to say, there are some interesting moves shaping up today, despite, as Kriti has also been telling us, volumes are very light. I would point out that in this U.S. futures session, we're seeing some underperformance from Russell 2000 futures. It's always interesting when we see this. It's down 0.3%. Some concern about the smaller cap, the more cyclical type stocks. Of course, it's the year end. Sometimes that's some window dressing moves. But what does this mean as we head into 2022 about whether the big caps tech stocks can continue to succeed? For their part, S&P 500 and NASDAQ futures up 0.1%. Now, some more sanguine moves in the bond market space. We're seeing a little bit of buying 10-year yield, 30-year yield lower by 1 basis point. We've just seen the 10-year yield tick under 1.5%. So unfortunately not ending the year on that nice round number, but still both the 10-year and 30-year yield hovering around their 50-day moving average rather. We saw some selling to start the week, so perhaps it's logical to end the week with some buying. Now, another asset that has been moving back and forth, a little bit of choppiness today, is your euro dollar. Dollar on track for its best year since 2015, given that we're seeing this policy divergence from the Fed versus the ECB. So we are seeing the euro trying really to put up some gains today, but not exactly doing so. It is up less than 0.5%. So those are some of your macro movers today. Kriti, what about some of the biggest movers when it comes to individual equities?
Yeah, Danny, we can't forget about the stock market. You know, yesterday, Romaine Bostick, our very own Romaine Bostick, asked me what was the best performing stock on the S&P 500 this year. And Danny, I failed that quiz miserably, so I thought I'd go educate myself. And this is where we have Devon Energy. That is your biggest percentage gainer for this year, a whopping 176% year to date. And it's not alone, because check this out. Marathon Oil is in second place. Once again, a 145% increase. And this has everything to do with that recovery rally, this kind of rebound in the commodity space and oil prices in specifically. We're talking about oil potentially hitting $100, $150. Well, the best kind of benefactors from that are going to be your U.S. shale players, and especially those that are very exposed to what's going on, particularly in drilling in the South. One of the decliners, though, is going to be Penn National Gaming, and it has nothing necessarily to do with macro. Of course, we're talking about Omicron variant stuff, but more of their woes coming from that legal battle is kind of casino gambling. Is that going to be legal or simply sports bet gambling? I should also add state by state, and you've really seen a lot of volatility in that stock, but that has not been what is the index contributors. On that basis, it is still big tech that is leading those gains, and for that, I really want to look at Apple, for example. Though that stock in particular has been gaining quite a bit and pushing the index to those record highs. I'm just using Apple here as a proxy for your Microsofts, your Alphabets, your Nvidias, but then with it, Tesla, which I think we're now also calling a big tech name, has been performing quite well. 52%, one of the major index contributors in the top 10 as well for the S&P 500. This has everything to do with that EV boom. It's not just Tesla alone. You're seeing it with Ford, with GM. They really are changing that dynamic, and it's showing up in the stock market. Let me show you the downside, though, because PayPal actually dragged the index. 18% decline, or a weight, I should say, on the S&P 500 year to date. A lot of that has to do with that crypto exposure, kind of this idea that they've accepted crypto as a payment. Therefore, when you see Bitcoin volatility, PayPal tends to get extra exposed to that. And lastly, Disney. I used to call this the best of both worlds, essentially that exposure to the recovery trade, but also that streaming network in their back pocket. Well, it turns out it didn't help either way. You actually saw them being about a 14% weight on the index. Danny and Matt.
Danny, isn't volatility just the obvious and automatic choice?
I don't know. I think for New Year's you pull out the Dom, obviously.
Wow, heavy hitter. All right, Kriti, Danny, thank you very much for that. I want to get over to Dana D'Auria right now, Co-Chief Investment Officer at Envestnet, joining us very graciously on this New Year's Eve day. Thanks so much for your time. Really appreciate it. Let me first ask you, even though we should be in a celebratory mood, if you're worried about inflation in 2022. We've had two guests so far in the last hour tell us they think we could see more than 7% in the first quarter.
Yeah, I think inflation is probably the biggest concern for markets as we move into 2022. It's not to say that we won't see it taper off to a certain extent, but we're considerably higher than where we thought we'd be, even given the reflation trade in 2021. And there's signs now, of course, that Omicron and the variants in general aren't going away, and that's going to create potential supply chain issues ongoing. I think we don't have the same lockdown issues potentially as we did in the beginning of this pandemic, but we still have the prospect of COVID disrupting supply chains, causing price increases to continue on. So I do think it's a concern that's going to be with us for a bit.
The fiscal spending that helped us in 2020 and 2021, does that still have a big effect on 2022? I know a lot of government programs take time to get off the ground and running. I mean, are we going to see a boost from that next year?
It's a great question. And I think the anticipation a lot of people might have is that we will. But unfortunately, most of the time with these infrastructure programs, it takes a while for that money to kind of seep in. right? So, and to the extent there's tax increases, those are immediate. So if we do get Build Back Better and there are tax increases, and that's a big if, as we all know, tax increases kind of tend to hit quickly. Infrastructure spending increases, it's a longer term prospect. So I don't see that helping us too much next year when we have a big fiscal drop off related to the spending we had this year, just related to COVID, right? And to helping the economy reopen. So we are facing a fiscal drop off next year as we head into 2022, likely lower growth, probably a little bit more volatility, but that's to be expected, right? A 27% year, you wouldn't expect higher growth.
Well, Dana, you're talking about this fiscal spending drop-off. I'm curious about the savings rate in particular, because at the peak of the pandemic, essentially, you saw the savings rate skyrocket to even higher than what you saw in the Great Depression, when everyone was really just hoarding their cash in their mattresses. Now you're seeing that savings rate actually come back to 2019 levels. How much of that impacts the money, not only in terms of spending, but how much of that money goes into the stock market?
So it's actually showing, I think, more up in the unemployment numbers. So what we're seeing is that we had a cushion for a very long time. You're absolutely right. Savings rate increased dramatically. It looked like people were really sort of socking it away, recognizing that the rainy day could be here for a while. But what we've seen happen, to your point, is that the savings have dropped off a bit. And the expectation and hope is that as that happens, we'll get more people back into the labor market. And that, of course, will be good for the stock market. So if we can recover some of the jobs, because we're still down, right, from where we were in terms of employment, and we've all seen the signs, everyone looking for workers and unable to get them. So hopefully as we get out of the pandemic, as we get past some of these variants, Omicron does look like it might not be, as dangerous. It's not to say it's not still a problem for sure, but, that potentially more manageable, then hopefully people get back to the labor market, and that is good for stocks.
Dina, in your research, you talk about managers rebalancing into defensive stocks, and these days tech counts as a defensive stock. Can it continue to, in a world where we're starting to see interest rates move higher and more regulatory scrutiny?
So it's been very interesting. Throughout the course of the pandemic, the hospitalizations, positivity rates have predicted a lot of things in the market to a certain extent. And one of them is sector performance, and it's really highly correlated with tech. So tech really became defensive during the pandemic, more so even than it was. I think that probably continues to a certain extent. And by the way, we also saw it predict like large cap versus small cap, value versus growth, right? So growth stocks, large cap stocks, tech stocks, those were doing well when we had increases in hospitalizations, increases in positivity rates. Do I expect that to continue into 2022? Probably to a certain extent, yes. It's the stay-at-home trade versus the reopening of the economy trade. That being said, I am a proponent of the reflation trade. I think if we can get past the surge that we're going to have with Omicron, we can manage it. We're seeing evidence from London now, even in the U.S., that perhaps it's not as lethal as other variants. We can get back to that reopening trade, and cyclicals, value stocks could do well.
Dana, thanks very much for your time this morning. Really appreciate it. And once again, Happy New Year to you and your family. Dana D'Auria there from Envestnet. Now, coming up in the next hour of programming on both Bloomberg Television and Bloomberg Radio, we are simulcast. Mercedes Carnathon joins us, Vice Chair of the Department of Preventative Medicine at the Feinberg School of Medicine at Northwestern University. We'll continue to talk about how to deal with Omicron and COVID on this New Year's Eve. This is Bloomberg.
Let's get to the first word news. And Hong Kong is becoming increasingly shut off from the outside world because of its strict strict coronavirus policies. The city has imposed a number of flight bans, and airlines such as Cathay Pacific have been slashing inbound services. Meanwhile, Hong Kong reported its first community spread of COVID in nearly 7 months. It may be linked to an aircrew member. In the UK, Boris Johnson's government said every adult in England has had the chance to receive a COVID vaccine booster. It's the critical part of the Prime Minister's strategy for tackling the Omicron variant. Still, the caseload is soaring, which is putting pressure on hospitals. British consumer spending rose 5.9% this year over pre-pandemic levels. According to Barclaycard, the increase was driven by a shift towards experiences at home. Spending on takeaways and fast food rose 62% in 2021. Spending on digital subscriptions was up 47%. The fourth quarter is turning out to be a good one for ExxonMobil. The company says higher crude oil and natural gas prices boosted quarterly results by as much as $1.9 billion. Shares of Exxon are up 47% this year, and they're on track for their best annual performance in at least 40 years. The top airline trade group in the U.S. has filed an emergency request for delay in the rollout of a new 5G wireless service near airports. Airlines for America says the 5G airwaves could interfere with aircraft equipment and disrupt flights. The wireless companies say they'll roll out the new service at temporarily reduced power in the coming months. And the celebrations have already begun. Around the globe, they're ringing in the new year. New Zealand did a spectacular light show at midnight in the city of Auckland. The traditional fireworks show was canceled due to the risk of COVID among the crowds who were expected to attend. And for our radio listeners, we're now showing pictures of that light celebration in Auckland. More to come around the world, even though we have seen a lot of cancellations. And as we get closer to the end of this hour, we continue to look at equities falling. We're looking at pre-market trading for the U.S. down by about 0.2% for S&P futures. It is a flat euro dollar as we've seen dollar dominance really dictate the pace of currencies so far this year. Your 10-year yield back above 1.5%, now above its 50-day average. And NYMEX crude falling nearly 2%, still on track for its best year since 2008. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 100 countries. I'm Danny Berger. This is Bloomberg.
During the pandemic, we hit volatility levels that actually surpassed 1987, as well as the other crises you mentioned. And so the fact that we've come down to pre-pandemic levels within the last 2 years compared to all the other situations where it took 4 to 5 years to normalize just kind of tells you how resilient the market has been overall.
That was Amy Wu Silverman, RBC Capital Markets equity derivatives strategist, breaking down the outsized moves in volatility this year. We sure have seen them. Let's take a look. Today, not really seeing much of a volatile trade, even with light volume, thin volume. S&P futures right now down 5. Euro dollar unchanged really at 113.33. The 10-year little change as well at 150.15. The only real movement you see on this board is NYMEX crude. Interesting to see it down 1 2/3%. Still, though, $75.74 a barrel is holding near the highs that we've seen for the month. So not a heck of a lot of movement, not a heck of a big surprise as we have most markets closed. In fact, I think the FTSE is now closed in London. We're seeing French, Belgium, and Dutch markets all kick off their closing auctions right now, so they'll be closed in just about 10 minutes' time. The U.S. not quite open yet, of course, but Kriti Gupta is there preparing for the open, and she's got a chart of the day on this New Year's Eve day. Kriti, what do you got?
Matt, I'm wide awake. I've got about 3 cups of coffee in me, so let's do this. This chart I'm looking at here is actually a fairly vanilla chart, but I think it's really important to talk about the value versus growth, the S&P 500 Value Index versus the S&P 500 Growth Index in the 21st century. So a quick history lesson here. I know you said you don't like dates, so I won't throw a ton at you. Essentially, that first dip you're seeing on the left side of the chart, really for our radio audience, what you need to know is that this kind of goes into this massive sell-off that you saw when it came to the IPO IPO bubble, essentially, at the start of the 21st century in 2000, and then you kind of saw this growth play that came about from that, starting in about 2007. But since then, you kind of have these calls that say, well, some of those airlines, the commodity sector, those value trades, those really industrial trades, well, they're going to make a comeback. And it's been about 15 years. And they haven't really done that. So one of the big questions coming into 2021 was, is this the year for that relationship to finally turn around and for the line to actually go up when you're comparing value to growth? And right now in 2021, we're ending the year and we haven't really seen that. So I think that was pretty interesting. I wonder if it'll turn around in 2022.
Yeah,
that's
Critty,
something I've been
I just know. Yeah, well, I was going to say, Matt,
Please.
I've been following it, too, because I really love to cover the quants, as you both know. And a lot of them, the value-type quants, continue to say this, Critty, that they're really hoping that value comes back. But, Matt, I do have to wonder, can we really forecast value coming back? As often it relies on a cyclical uptick, that we need the economy improving. And we have talked to so many people who say, OK, this isn't a normal market cycle anymore. We can't really discern whether, we're late cycle, early cycle, or what have you. So what does value do in that environment?
Yeah, I have to say I'm following it very closely also for the past 20 years, but really the past decade, and it'll be interesting to see if we do get a turnaround. Someone else who follows this closely, you both know quite well, Daniel Curtis is a Bloomberg producer, a star producer, and an Olympic-level rower who has recently moved from New York City to London to work for us at our offices there in Queen Victoria Street. Look at what he just got. What an awesome New Year's Eve present.
Baby Curtis, otherwise known as Baby Charts. We hear that there's a backstory involved. We are waiting to hear the details. But for now, we're very happy. And for the folks in New York, by the way, we really miss Dan Curtis. And we're very jealous of Danny Berger, who has Dan Curtis in the office.
Yeah,
not cool.
Yep, I am very lucky. And for our radio listening audience, you just need to know that we have an adorable picture of little baby girl up on the screen. I think she has raccoons or bears or something. If that is bears, is Baby Curtis trying to send us a signal of what's to come for equity markets next year, Matt?
Oh, now we know.
I am, regardless of what happens, we're happy that Baby Curtis is healthy, and we're looking forward to, well, I hope actually Dan gets to spend some time at home. It's so important. I did it when I had a kid. Take some time off, be with that baby, bond with that baby, and really start off making an impact in that baby's life. When he comes back, I'm excited to get a morning chart note in the European hours. So that's the cool thing about Dan Curtis.
I think there's
to London.
I think there might be some Bloomberg surveillance branded little mini rowing oars for the new baby. I think they're on their way. Branded, like I said.
I wonder if Dan Curtis is that the real reason that he moved to London? Is rowing a bigger deal in the UK than it is in the US? Because I know he spent a lot of time down at the New York Athletic Club in their Pelham area, put in the water on the oars. But I wonder if he's going to be. What's the big race they have?
The regatta,
it's like
right?
Henley Regatta.
There you go.
Avon, Henley on the Thames.
Henley.
Or Avon upon Stratford.
I will say,
or something.
Matt, a fun fact, Critty and I both went to the same school. We both went to University of Virginia, which does have an excellent crew and rowing team, but I have never watched a single race until I moved to London and watched the Henley Regatta.
And now we know,
Well,
folks.
was it cool?
It was very cool.
What was better?
Cool. Right.
Was it like Foxfield or Henley? What was the better experience?
Well, one I remember more than the other, and that's probably all I will go into. Matt, Foxfield is some horse races that happens at UVA. So there you go. That's your Who knowledge of the day.
I like it. Ascot is one that I also don't remember.
Yes.
A horse race that I
I was going to say it's the
don't remember.
UVA version of
In any
Ascot
case,
with less cool hats. It's fine.
Let's say congratulations to Dan Curtis, his wife, and his now 2 little baby children. We wish them the best of health and happiness on this New Year's Eve. And we're glad to welcome just one more member of the Bloomberg family. In terms of the markets right now, you're looking at very little change, as you might have expected, very little volume, as we've been telling you all week we're going to get. of course, most civilized nations offer this day up as a holiday. In the U.S., I have no idea. I do know why. You know, apparently, if a holiday falls on a Saturday or a Sunday, according to the New York Stock Exchange rules, Critty, you get the Friday or the Monday off, unless it's the last day of a quarter or a year. And since this is both, that's why the New York Stock Exchange isn't giving you off. In Sydney, do they have it off in Sydney? Let's ask our executive managing director, Brad Hodson. I'm not sure.
I believe they're gearing up to do some fireworks here, but I wonder also if New York Stock Exchange knew it was John Ferro's birthday. But let me just add, I've been waiting for 2 hours to jump in on this very important date, because it's not just John Ferro's birthday, it's also gymnast Gabby Douglas's birthday and Diane von Furstenberg's birthday as well. So let's just wish them also a very happy birthday today.
Oh, that's so kind of you to look that up and share that knowledge with us. Happy birthday, John Ferro. Happy New Year's Eve day to all of you out there. Critty and Danny and I will be with you here for another hour. Coming up, Christina Hooper, global market strategist at Invesco, joins us to preview 2022. This is Bloomberg.
The Fed has quote unquote pivoted, but it hasn't really done anything.
The COVID shock itself was extremely narrow and severe, and the policy medicine was incredibly widespread.
There is some limitations in really what the Fed can do given where a lot of these inflation pressures are coming from.
Really just what the long-term Treasury yields are telling us is that the Fed really can't hike that much.
We're heading towards a mid-cycle slowdown for 2023.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
From Sydney, Berlin, London, and New York, for our audience worldwide, good morning. This is Bloomberg Surveillance. You can see Australia celebrating the new year there. The markets were indeed open in Sydney today, and they're celebrating a 13% gain, so double digits there. Nothing like the gain that we have seen on the S&P 500. Kriti Gupta with us out in New York, Danny Berger in London, Tom Keene, John Ferro, and Lisa Abramowicz are off today to celebrate New Year's Eve. But 27%, Kriti, is the year-to-date gain that we've seen on the S&P 500, and this follows a 17% gain last year, and I think a 29% gain in 2019. So we've seen some incredible gains. The S&P 500 up, I think, 134% when you include reinvested dividends over the past 3 years.
Yeah, and I mean, I have done the math, Matt, but it's really clear that it's all of that is a good chunk thanks to tech and really that defensive trade. My question, though, is in 2022, how much of that really continues when you start to see decelerating growth? I mean, do you continue to see the tech trade, and does that mean that we have perhaps progressed past part of that early part of the market cycle? I mean, that's really the question going into 2022. How do you play a lot of the concerns that persist from 2021 into the new year, Danny?
Well, it does just seem like the cycle just doesn't exist anymore. But, Kriti, look, we could have known perfectly what inflation would have done. Matt and I were talking to Sheeman Power earlier today, who did call inflation quite correctly. But even if you knew that going into the year, would you have guessed that 10-year yields would end the year at 1.5%? I would guess not, Kriti. I mean, it is a market where inflation is unpredictable and the market reaction just seems to be up regardless of whatever it is.
Yeah, and it really brings to the point, like, let's just take a look at cross-asset correlations. Danny, you were a star of our cross-asset team here, so you know this better than anyone else. When you start to see, say, the stock market rally, yields rally, commodities rally, those three all one kind of pocketed bundle trade, and we haven't actually seen that. We've seen some of those correlations come apart where we're seeing the stock market hit records high, commodities rallying, and the bond market be kind of repressed while you still see dollar strength. I mean, I think even today you're seeing commodities really show the strongest move, even on this kind of very quiet trading day. To Matt's point, oil, for example, down 1.4%, even in the face of a stronger dollar. Oil has rallied quite a lot this year.
Yeah, it really has. And again, yeah, go ahead, Matt.
Well, I was just going to say, we see the biggest moves we really do see in commodities. We were talking about this, Danny, I think about 4 hours ago now, that you're seeing, for example, huge moves in, well, once again in iron ore, big gains overnight in Asia as some inventory issues, some orders are put in China. You see huge moves in natural gas. To the downside here in Europe, the Dutch contract off, I think, 14%. You saw big gains in U.S. natural gas contracts, more than 2%. And we see the biggest moves on the board in oil today as well. Look at the bottom there, NYMEX crude down 1 2/3%. So it's really commodities that are moving the most today.
Yeah, it certainly is.
Oh, go for it, Danny. I feel like I'm all tapped out on my commodities knowledge. You're going to get me into a spiral of talking about the trade war in 2 seconds. You should just rescue our radio and TV audience. Just go for it.
Well, let's go ahead and bring this question.
Wait, let me actually just quickly jump in and give you a surveillance correction, because I said the S&P was up 134% with reinvested dividends over the last 3 years. That's actually a 5-year stat. The reason it stuck in my head is because I use the comp function, COMP, on the Bloomberg terminal all the time, and it gives you an instantaneous 5-year look. So with reinvested dividends over the past 5 years, the S&P is up 134%. If you look at it over the last 3 years, the gain is 102.5%. So that makes more sense. Obviously, if you take out the dividends, just a straight price change, it's a 92% gain. It's been an incredible run, no matter how you look at it. Christina Hooper joins us, global market strategist right now at Invesco. And Christina, you know, we have been talking to so many investors who have told us they see lesser returns in 2022 than we've become used to over the past 3 years. Do you agree?
I agree, but let me give you this caveat. I think we're going to see lesser returns when it comes to developed markets, but I think 2022 could be a great year for emerging markets, and that's a year for outperformance for EM, in particular China, which has had a disappointing 2021.
All right, so China is one area that we're watching incredibly closely, not just because of the blew up in the property market, but also because they seem set on increasing stimulus and making it really focused. Do you expect that to bring decent gains, both for China and for the global economy?
I do. I think it's going to be a combination of monetary and fiscal stimulus that helps the Chinese economy reaccelerate in 2022. And I think we're likely to see fewer regulations, right? We saw a lot of regulatory actions directed at reform in 2021. I think we're going to see less of that in 2022, and that should be another positive catalyst for China equities. But for developed markets, I think what we're going to see is more of a convergence of asset classes. That typically is the case when we enter a slowdown phase of the economic cycle. It's nothing to be scared of, but I do think we're going to see more muted stock market returns.
Well, in terms of China, we saw the Golden Dragon China Index, which, of course, is the ADRs listed in the U.S., return 9.4% yesterday, their biggest gain since 2008. Of course, it's still very far off the highs. Is China tech a place that interests you?
Oh, absolutely. Now, we certainly have to recognize that China has some long-term policy goals that are part of its common prosperity vision. So we have to recognize that there could still be more regulation to come in, but I think it's pretty understandable the areas they're focusing on, like, for example, data security. But having said all that, there is a lot of opportunity for Chinese technology stocks. I do think we need to be more patient with that. This may not be a 2022 phenomenon. It may be something that is a good story for longer-term China tech holders.
Christina, let's talk about a second for the Omicron variant, because we have to hit about the impact. Now, the consensus on Wall Street is that this isn't going to have quite the same impact on, say, operations, on consumer spending that the original strain of the virus did back in the spring of 2020. But I'm curious how much of 2021's gains were based on the fact that we are going to have this return to office, that we are going to have this kind of much bigger progress in vaccines. What is your take on that? How much of those gains might we have to pare back in 2022 as we kind of face reality?
Well, I don't think we're going to see a big paring back of gains because the Omicron variant represents negative outcomes in the shorter run, but could actually be a positive in the longer run. And by that, I mean that it is incredibly contagious. And the numbers we're seeing are just like nothing we've seen with any other variant. Having said that, the silver lining is that it does seem to be far more mild, and it moves through populations rather quickly. So we can take South Africa as an example. Cases peaked on December 16th. Now we're seeing cases at less than half of what they were then. So this is a really fast move through South Africa, already burning out. So if we can use that as an example, and that really does happen with other countries, and it seems to be the case from early indications in some other areas, then that suggests that it will move through the population rather quickly, create some real issues in the shorter run, right, in terms of supply chain disruptions, exacerbating inflation, but then could move through quickly and have that residual effect of having immunized populations far more rapidly than, say, any vaccination program. So it could be a positive, again, if it remains as mild as it seems to be.
Are you worried about the Fed in 2021? I know that the market is expecting 3 rate hikes, and March is reportedly, according to Governor Waller, a live meeting. But if they don't start until later, they're going to have to squeeze them in pretty tight.
Yeah, so I'm not worried about the Fed. I mean, certainly we always want to be following inflation and inflation expectations, and that is a wild card because there is an element of behavioral economics to all of this. But having said that, I do believe that the Fed will have only 3 rate hikes in 2022 or less. And the market expects 3 rate hikes. So I think that creates a relatively supportive environment for risk assets. Certainly, we're going to see some volatility. There is going to be some uncertainty along the way with regard to monetary policy in the United States. But I think ultimately we won't see the Fed get nervous and overreact to any kind of high inflation print.
All right, Christina, thanks very much. Pleasure having you on the program, and we wish you and your family a happy and healthy New Year's Eve. Christina Hooper there of Invesco giving us her outlook for 2022. Well, as we've been talking about, it's been a banner year for markets in the U.S., especially in 2021. We're looking at a 27% gain, even with the drop that we're seeing now in futures. The S&P 500 down 5 points, NASDAQ futures leading the way down. Euro dollar unchanged at 113.29 and the 10-year unchanged at 150.49. But we do see NYMEX crude moving more than 1.5% to the downside. Right now trading $75.74 a barrel. Coming up, Daniel Tannenbaum, partner and anti-financial crimes leader for the Americas at Oliver Wyman. This is Bloomberg.
Let's get to the first word news. And the Kremlin says Russian President Vladimir Putin is satisfied with the outcome of talks with Joe Biden. The phone conversation set the stage for 3 sets of negotiations on European security next month. The White House says President Biden urged Putin to de-escalate tensions with Ukraine. The president warns that the U.S. and its allies will respond decisively if Russia invades. The Omicron variant is setting some grim records. For the first time, the number of new daily COVID cases reported went over 2 million. It's the 4th day in a row of more than 1 million cases, and that was a record reached earlier in the week. A devastating wildfire in Colorado has destroyed hundreds of homes and forced thousands to evacuate. The disaster took place outside the city of Boulder. The fast-moving fire spread through neighborhoods in a matter of only hours. One official says close to 600 homes may have burned down. So far, no reports of casualties. In China, President Xi Jinping vowed to take on risks that could disrupt the country's march towards development. In a brief New Year's Eve address, Xi said that realizing China's rejuvenation will not be an easy task like a walk in the park. Xi is preparing for a Communist Party Congress during which he's expected to secure an unprecedented 3rd term. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 100 countries. I'm Danny Berger. This is Bloomberg.
The last thing you want is for them to have to pivot really quickly to a hiking cycle, because remember, they're dealing with an economy and they're dealing with a market that has been conditioned for years to live with floored interest rates and massive and predictable liquidity injections. So this is quite a change, and that's why you don't want the change to be too abrupt.
That was Mohamed El-Erian, Bloomberg opinion columnist in Queens College, Cambridge president, speaking yesterday to Jonathan Ferro on the Open. Always great to get some time with Mohamed. Right now, we're looking at markets that are, futures are indicating a lower open on the S&P 500. In most of the world, markets are closed. All across Europe, we've closed early. The markets that were even open to trade, for example, the FTSE was open this morning, but it closed early. The DAX has been closed all day long. The U.S. Stock Exchange, the New York Stock Exchange, as we were explaining yesterday, John looked it up in the rule book, cannot close on the last day of a quarter or the year if even if they want to give you a holiday for one that falls on a Saturday or a Sunday. So that's why the U.S. Stock Exchange is trading. The bond market will close early today. You can see the 10-year yield not doing a heck of a lot right now at 150.32, but they just do a half day on New Year's Eve regardless. The euro not doing much. We've seen some great dollar strength this year, bringing the euro down to 113. I noticed earlier the dollar buys 115 yen. So even without huge dollar strength or much movement in FX today, it's still at a relatively high level. The greenback is against the euro, against the yen, against other currencies. The interesting thing here is that NYMEX crude continues to move down, now off almost 2% at $75.53 a barrel. We have seen it come off, although still NYMEX and Brent crude, the global benchmark, are hovering near their one-month highs. Let's talk about geopolitics right now. Daniel Tenenbaum, partner and America's anti-financial crime leader at Oliver Wyman, joins us to discuss not just the phone call that President Biden had with President Putin yesterday, but also the relationship and the issues that Russia has right now with the West as it amasses troops on the border of Ukraine. Reportedly. Dan, thanks so much for joining us. How do you think the call went to kick it off?
I mean, on New Year's, I'm feeling a bit light. I mean, it was a perfect call for both sides. Realistically, I think both Putin and Biden got their messages in where both sides can declare victory. It was largely reiterating prior points that both sides made in terms of Russian demands, of what it was looking for from an assurance standpoint for security, what Biden was looking to put out there in the event that Russia escalated issues, which were largely further sanctions in the event of a further escalation into Crimea or into Ukraine. So I think realistically, both sides were able to walk away with a win, and it really set the tone nicely for the talks that will commence on January 10th with kind of the working level within both governments to try and see how they can de-escalate the situation. But I mean, as a reminder, this is largely a crisis of Putin's creation. There was no imminent security threat against Russia. This was a preemptive move to move troops into the Donbass and begin to threaten Ukrainian sovereignty.
Dan, in 2014, I could exchange a dollar and get 36 rubles in return. Now, if I exchange a dollar, I get about 75 rubles. Really, since that Crimea annexation in 2014, that really spurred a lot of those sanctions from the United States, in addition to that big drop in oil prices we saw then. The ruble has never recovered. Oil prices did, but the Russian currency didn't. And a lot of that is thanks to sanctions. Just how much further of an impact can sanctions have on Russia right now?
So the sanctions that were imposed in 2014 were very targeted. They were focused on certain aspects of the financial services, energy, and defense sectors. But there is more that could be done. The threats that have been levied were a focus on potentially cutting Russian financial institutions off from global payment systems access. further sanctions to more significant oligarchs, and escalation of what President Trump did in 2018 with a number of significant oligarchs where their assets were frozen. There are still more sanctions that could be imposed even on Nord Stream 2 in potentially cutting off the usage in Europe of the Nord Stream 2 pipeline, which would have an adverse impact on the Russian economy. So there is still more that can be done. The 2014 sanctions were very surgical in nature. What's being threatened now is much more of a broadsword approach.
Wouldn't cutting off Nord Stream 2 be a problem for Germany as well? I mean, clearly they rely on Russian energy supplies, and isn't that a faster, cheaper way for them to get it?
It is, and especially coming into the colder winter months, it's not really the best time of year to start talking about cutting off any sort of access to cheaper fuel. It is still something that the U.S. has been pressuring its German and other European allies hard as one of several options and potential sanctions that could be imposed, but it is probably one that's been less interesting to the Biden administration to push forward, and something we've seen from Congress in the U.S., where both Republicans and Democrats have been pushing for more action on Nord Stream 2, even though it's completed. And this is picking up off of an issue that wasn't dealt with properly on the Trump administration side.
Dan, beyond sanctions, another stick that U.S. officials have waved is the possibility of the augmentation of NATO forces should diplomacy not work. What effect would that have, considering Putin's narrative has been that NATO continues to move east?
I think there's no imminent threat, as we understand it, of further deployment of NATO forces into Ukraine, unless there is certain actions on the part of the Russians to escalate. I think there's certainly talk of using troops to bed down any sort of Russian escalation, any sort of Russian incursion into Ukraine, but that certainly seems to be a last measure. That being said, we have certainly seen sanctions have impacted the Russian economy, but they've certainly not necessarily scared off President Putin. And President Putin seems to understand force above all else.
Dan, great to get some time with you. Thanks so much for joining us. I think we really gain a lot from your insight, Daniel Tenenbaum there, of Oliver Wyman talking to us about U.S.-Russian relations, and we wish you a happy and healthy new year as well. Coming up after we take a quick look at the markets, we're going to talk to Mercedes Carnathan, Vice Chair at Northwestern University Feinberg School of Medicine. Here you see S&P futures down 5, almost 6. Euro dollar unchanged. U.S. 10-year yield unchanged. Crude is where it's at. The movement that we see, as everyone's been saying, is really in commodities. We'll be back with more on COVID. This is Bloomberg.
This is Bloomberg Surveillance, live on Bloomberg Television and Radio. Matt Miller, Kriti Gupta, and Danny Berger in for Tom, Jonathan, and Lisa. Now, we're still in pre-market trading for the U.S., with many markets in Europe closed lighter volumes than usual, off as much as 90% in some indices in Europe. We are seeing S&P 500 futures near their lows of this pre-market session, down more than 0.1%. One area that seems to be protected from the pre-market losses is NASDAQ 100 futures. Those are basically unchanged this morning. When we see small caps continue to decline, those are down 0.2%. So it is the more economically sensitive type equities which are underperforming. This is a bit of a reversal from December. For December, it has been those small caps that started to edge ahead of the large cap stocks, so that hasn't been the trend for the full year. Now, when it comes to the bond market, things look more sanguine, as they have been for the year-end volatility. Bond markets not reacting too much. We don't have have any moves between 2, 10, and 30-year yields that are greater than 1 basis point. We are seeing buying, though, slight buying, I should say, across the board. Now, we are on track for Treasuries to return a negative 2.5% this year. That would be the first yearly decline since 2003. According to Vanguard and BlackRock, they think those declines could continue next year if inflation starts to ease. Now, historically, losses are followed by gains, but again, the warning is that might not continue. Now, also looking at the euro dollar this morning, we've been fluctuating between gains and losses, having a hard time finding any direction, and we have the dreaded unched at the moment, unchanged on the euro dollar. Still, the dollar mat headed for its best year since 2015.
All right, Danny, thanks very much for that. Danny Berger there with an excellent look at your markets this morning. Let's get over to David Wilcox, Director of U.S. Economics Research at Bloomberg Economics. And David, I was thinking as I read through your notes, it'd be great if you could just frame for us, as we kind of mark the unofficial 2-year anniversary of COVID, how the U.S. economy has performed during the pandemic.
Well, thanks for having me on. It's been an incredible macroeconomic journey. The collapse in March and April of 2020 was unlike anything that any living economist had seen, with the unemployment rate reaching a level close to 15%. That was well on its way toward Great Depression levels. Mercifully, that proved to be a brief collapse, and if anything, the recovery from that has been stronger than many analysts had expected. We've made an awful lot of progress just over the past year, and in total, about 80% of the jobs that were lost in March and April of 2020 have been recovered. Next week, we'll get another employment report, and that's expected to show an unemployment rate close to or at 4%, which is quite a low level. So we've made an awful lot of progress in the recovery.
What do you expect in terms of the recovery in 2022? You know, there's been a lot of, clearly a ton of infections in COVID. I mean, we have more than 2 million globally today, and this is the 4th day in a row of over 1 million. But there hasn't been much concern about negative impacts on the economy or indeed bad data yet.
Well, an interesting characteristic that's going to play prominently in 2022 is that the economy seems to be becoming less sensitive to the latest turns in COVID. We're seeing record-breaking numbers of cases, as you're suggesting. That is creating some severe problems, but nothing like the shutdowns that we saw early in the COVID period. There are some substantial challenges that the US and global economies confront for 2022. Those all trace back to COVID. The surest way that we can have of addressing those challenges is to get the disease wrestled to the ground.
David, we're hearing constantly about, of course, a severe shortage in workers, severe shortage in products, of course, inflation as well, just skyrocketing as well. How quickly does addressing those supply chain concerns turn into an inventory surplus? Is that something we should be worried about?
I don't think so. For 2022, the more predominant challenge will be to resolve some of those shortages that you mentioned. Workers remain to this day reluctant, for understandable reasons, to come back into the workforce. They may have caregiving responsibilities in the home. Some workers still face child care situations that are not stable. Young children are still unvaccinated and so not able to be in group settings with the high degree of assurance that parents would like to have. These problems are going to take some period of time to resolve, and I expect it'll probably be into the second half of 2022 before we really see substantial progress on some of these longstanding issues.
David, just following up on supply chains here, I mean, one of the new mantras from corporate America has really been the idea of bringing your supply chains closer to your end consumer so you're not dealing with these shipping delays. How much could that actually impact growth here in the United States?
These supply chain issues are going to be quite difficult to resolve. For example, to build a new chip factory, which is one of the key choke points in the economy today, takes 2 years from a greenfield to having chips roll off the line. So these are not quick fixes. The faster way to get these problems in the rearview mirror is to get COVID resolved in a more thorough manner. And that's going to have all kinds of therapeutic effects. It will cause, just to take one example, it will cause the incredible demand for goods at the moment and shift that over to services. Some of the areas where people have been reluctant to spend lately, in restaurants, in entertainment, in travel, that sort of thing. Taking some of that strong demand for goods and shifting it over to services is going to take a lot of pressure off the supply chain.
Yeah, it's interesting. I certainly have heard that argument before of the shifting from goods to services. I do wonder, though, once we get that shift, once the economy starts to normalize, what does the labor market look like afterwards? How fundamentally changed is this labor market?
It's one of the great questions for 2022 and beyond. I think we're going to see some profound changes that persist after the COVID period has passed and after the normalization has occurred. I think we're going to see a lot more flexible work arrangements. Perhaps we'll see a resurgence of worker power. One thing that's really interesting that we're seeing right now is workers clearly are in the driver's seat. They're quitting their current jobs in favor of situations that they think will be better for them. They're demanding higher pay, and in many cases, they're getting it. This is a tight labor market, and that favors workers.
So if it is a tight labor market, does that mean, as you say, the concern here is COVID, but could it also be a wage price spiral as well, with the power being in that of the laborer?
It's a possibility, and that's something we haven't seen since the 1970s, really not in the professional lifetime of today's economists or other analysts or policymakers at the Federal Reserve. We're not really seeing that today, except in some very limited sectors, like in the restaurant sector, you're seeing some pass-through of higher wages into prices. But broadly, we're not yet seeing that dynamic take hold. If we don't, the situation is going to be much easier to deal with for the Federal Reserve and other central banks around the globe. If that wage price dynamic that you're referring to does take hold, then the situation becomes much more pernicious.
David, can I finally ask you about the supply chain problems that we've had? If this supply chain difficulties were a baseball game, what inning do you think that we'd be in right now?
Oh, gosh, I think we're in about the 5th inning. Long way to go. Better go out and get yourself another soft drink and maybe some Cracker Jacks. We're not at the 7th inning stretch yet. These problems are proving more persistent, more difficult to resolve, and they cascade on one another. And so what we're seeing is that one difficulty leads to another. Just to give one example, shortages of goods has led to preemptive ordering. Guess what? Preemptive ordering means that there's more demand being pushed through the pipeline, and that's creating additional shortages. On the bright side, as these problems begin to resolve, you'll see a sort of cascading of improved situation too. So this won't be quick to resolve, but once it does begin to do so, I think the clouds will clear reasonably quickly.
All right, David, great having you on the program. Thanks so much for joining us on this New Year's Eve day. David Wilcox there talking to us about the economic situation in the U.S., really and globally. He's the director of U.S. economics research at Bloomberg Economics. We are looking at markets that are just about to kick off in under an hour on the New York Stock Exchange. S&P futures down about 5 as they have been for most of the last hour. little change in terms of the FX markets, in terms of the rates markets. Of course, the bond market will close early today. It's only going to be open for a half day, typical of the bond market to get out of work before the equity guys get off the floor. It's really been the commodity markets that are moving the most, though. NYMEX crude down now almost 2%, $75.53. You got to wonder what's happening in those markets, especially as we see other commodities rise. Iron ore, for example, was up for another day overnight in Asia. Mixed trade in terms of nat gas down here in Europe, up in the U.S. Coming up, Mercedes Carnathon, vice chair at the Northwestern University Feinberg School of Medicine.
Let's get to the first word news. And in Israel, the health ministry has approved a fourth dose of the coronavirus vaccine for highly vulnerable populations. That's a step back from the original plan to give it to everyone 60 and over. The extra shot will be available for people who are immunocompromised, residents of nursing homes, and patients at hospitals for the elderly. In the UK, Boris Johnson's government said every adult in England has had the chance to receive a COVID vaccine booster. It's the critical part of the Prime Minister's strategy for tackling the Omicron variant. Still, the soaring caseload is putting more pressure on hospitals. British consumer spending rose 5.9% this year over pre-pandemic levels. According to Barclaycard, the increase was driven by a shift towards experiences at home. Spending on takeaways and fast food rose 62% in 2021, while spending on digital subscriptions was up 47%. The fourth quarter is turning out to be a good one for ExxonMobil. The company says higher crude oil and natural gas prices boosted quarterly results by as much as $1.9 billion. Shares of Exxon are up 47% this year, and they're on track for their best annual performance in at least 40 years. Tesla and Elon Musk may have extra to celebrate for New Year's Eve. Workers are pushing towards record quarterly deliveries in the last hours of 2021. If they succeed, that would cap a year in which the electric car company's market value zoomed past $1 trillion. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Danny Berger. This is Bloomberg.
The idea that the home tests are probably not being reported as effectively to public health officials, all of that is contributing to a real undercount in the number of cases that we're seeing outside of obviously hospitalizations and deaths, because we can get pretty accurate numbers on those.
That was Andy Peckosh, professor and virologist at the Johns Hopkins Bloomberg School of Public Health, delivering a reality check on our accounting of the pandemic earlier on in the program. We had another day of more than 1 million, in fact, now more than 2 million new infections globally. Andy Peckosh says it wouldn't surprise him if the real number is 5 million or 10 million. He thinks we're drastically undercounting. And indeed, if you test positive at home, Critty or Danny, especially if you don't have to call in sick to work, or even if you do, who are you going to tell? I mean, who are you reporting that to? How is that data getting out there? As long as you're feeling okay, you're not going to go to the hospital or probably even call your doctor, right?
Well, one of the issues also, and we were talking about this earlier in the program as well, that the symptoms for Omicron tend to be that of a more common cold. You have a runny nose, so perhaps you're not even testing yourself. But Critty, for the economy, the issue really is if you're going out and getting COVID, perhaps it's not as severe, but you're isolating, and that obviously has an issue for the labor market.
Yeah, and then factor in the fact that you have several different states giving you different guidance in terms of what you need to actually go to restaurants, to go to bars, to go to movie theaters. And it really does become a story of messaging about what is safe and what should be those normal practices.
We're going to talk a little bit more about this in just a moment with an expert, but Critty, why don't you run us through what we're expecting today at the Open in New York?
Yeah, well, I mean, light volume, light liquidity, that seems to be really the name of the game, not just today, but this week in particular. Like you said during this entire show, really all the action is going to be in the oil market. But I want to hit some of those other markets too. The euro dollar, for example, about flat right now, about up 0.1%, just barely moving there. But it was a little bit volatile earlier in the session. Futures, of course, lower for the S&P 500. We're going to the 10-year yield, basically unchanged on the day, still hovering around 150 basis points. The VIX, though, at a 17 handle, dropping below that 20 handle for a couple of days, a couple of weeks now, I should say. That's going to be the key metric to watch going into 2022, Matt.
I will say, I just
right.
want to point out, NASDAQ 100 just slipping into the green, Matt. So some positive news there for tech to round out your 2021.
Yeah, we could see maybe a reversal of what we saw yesterday with gains most of the day and then selling in the afternoon into the close. Maybe you see a turnaround of that going into the end of the year. As we all know, window dressing is real, right? You see often fund managers stocking up at the end of a quarter or at the end of a year, or this is obviously both. So that's a definite possibility. Let's get back to the virus, because the numbers that we have seen are just eye-popping. As I said, more than 2 million confirmed new cases in one day globally yesterday. It's the fourth day in a row of more than 1 million. Mercedes Carnathon joins us, vice chair at the Northwestern University Feinberg School of Medicine, Department of Preventative Medicine. And to some extent, this is preventable, Mercedes. But we see the numbers just popping up. Is there any way to turn this around now, or does everybody eventually get the Omicron variant?
You know, it's a really scary situation, and thank you for having me to talk about it. All along, we've known that this particular variant was highly contagious and was infecting people even before they knew they had significant symptoms. And then with it being slightly less virulent and a large proportion of our population being vaccinated, the symptoms can be so subtle that it's really spreading. I mean, I hate to say we throw in the towel and accept that everyone gets it. That's not what we want to do, because we still don't know what the long-term impacts will be. I think we've got to double down on the masking. We've got to really emphasize and encourage vaccinations.
Mercedes, when schools return next week, what should they be doing? What measures should they be taking if they are in person to prevent a spread of a variant which has been spreading exponentially?
You know, that's a real concern. I've got young children who are heading back to school. I feel very strongly that they are safer in school than they are on play dates that are happening in a much more casual setting, and even some general public places that you might take them to have some fun. So I think returning to school must be a priority. I think that a central strategy to keeping children safe in school is going to be testing. It's going to be surveillance testing so that you can get a picture of the background rates of the virus within the community and population of the school. And it's going to be testing symptomatic and asymptomatic people so that we can isolate them quickly.
Let's talk about the isolation period for a second. We just heard from the CDC very recently that now if you are asymptomatic, you only have to quarantine for 5 days. It's a ruling that has had some industries, the airline industry is what I'm thinking of, really up in arms about it. What are your thoughts about simply the safety and the effectiveness of that strategy?
You know, I think that when the CDC and other organizations have to select a strategy that involves individual behavior, there are always trade-offs, and it can always feel as though it's a choice between two least bad options. The reality is that the recommendation is science-driven. We have seen throughout that the infectious period can be relatively short, particularly in individuals who are vaccinated. What becomes more challenging is the unvaccinated and really needing to have separate recommendations, and the CDC chose not to do that and to make the single recommendation. Certainly, upon release from isolation, masking should still be used in order to protect other individuals.
All right, Mercedes, thanks so much for joining us. Really appreciate your time on this should-be holiday on this New Year's Eve day. Mercedes Carnathon there of Northwestern University joining us to talk about the seriousness of the COVID challenge that we still face. In terms of the markets, we are still seeing S&P 500 futures down ahead of the open on the last day of trading, now only down less than 4%. As Danny Berger just mentioned, the NASDAQ futures are rising. I made a window dressing comment, Danny. Was I wrong?
Well, I do have to say, Matt Maley over at Miller Tabak points out that the last trading day of the year and the quarter isn't always boring. That the end of the third quarter, we had some pretty big moves to the downside. And he says that there's some speculation rumbling out there, Critty, that the expiration of some year-end options could produce the exact opposite move. Of course, though, Critty, we are seeing the VIX rise higher today.
It is rising higher. Now we'll see if that tech kind of move follows it. It's hopefully a good news for us. Hopefully there is some more action because Matt and I still have a couple hours to go, right, Matt?
It's good news for Michael Purvis because he closed his VIX shorts. So as it rises, he sees that he made the right decision, at least for today. Thank you so much for joining us. On Monday, Surveillance will be diving into the Eurasia Group's top risks for 2022 with Ian Bremer, Elizabeth, as well as Elizabeth Economy of the Hoover Institute and Jane Hartman of the Wilson Center. Stay with Bloomberg. The Open is next on Bloomberg Television. Surveillance continues on Bloomberg Radio. Happy New Year. This is Bloomberg.